Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. We have a mission today that really touches on three colossal, yet I think fundamentally risky areas of the modern investment world.
It feels like everything is connected right now.
It really does. We're looking at some high-stakes data across the crypto market first. Then we're going to dissect the surprising and maybe immediate fragility that's brewing inside the white-hot AI infrastructure boom.
And finally, a big one.
A really big one. We're analyzing a massive multi-billion-dollar strategic move by one of the world's most respected investors, Berkshire Hathaway.
That's right. And for you, the listener, the goal here is to get absolute clarity in a time of just extreme noise. We're going to try and cut through the volatility, the breathless hype, and honestly, the fear.
Right.
And synthesize what these major shifts actually mean for your capital, for your strategy. We'll focus on actionable insights, some simple analogies to explain these complex financial mechanics.
And I think this is the most important part. Identifying exactly where the genuine structural risk is versus where true value might be, quietly hiding.
Exactly.
And we are not wasting any time today. We are jumping straight into the deep end with Section 1 because the data we've researched strongly suggests the crypto market is facing a very difficult reality check. This is decoding the crypto winter, the paradox of the MicroStrategy discount. Okay, so let's unpack this first finding. We've all seen the intense volatility lately, but the crucial point is this liquidity shift, and specifically, the drain.
The drain is the word for it.
Recent analysis shows that October saw a staggering outflow of over $800 million from crypto funds globally.
$800 million.
And that's not just, retail selling. That is institutional capital pulling back hard.
That figure, $800 million in 1 month, that is a monumental evacuation. It really highlights a major structural shift. And to truly grasp the scale of that panic, let's use a simple analogy.
Okay.
Imagine an exclusive private investment party. The total capital pool is like, all the food and drinks on the table.
Right. The life of the party.
Exactly. Suddenly, the guests representing $800 million of that pool don't just leave quietly. They rush for the exits, and they physically take that liquidity, that cash, out of the system.
They take the refreshments with them.
They take the refreshments with them. And that sudden absence of capital, it creates a vacuum. It forces prices down sharply because there are simply no buyers left at the party to absorb the selling pressure.
And the immediate question that follows is, where did this institutional capital go? I mean, did it just evaporate or did it relocate?
It relocated. Or, perhaps more accurately, it was forced back into the safest corners of the market.
Yeah.
We're talking primarily short-term treasuries or even just being held as cash.
The flight to safety.
A classic flight to safety. But what's crucial to understand here is the subsequent behavior. The data for the first week of November shows this panic selling has significantly stabilized.
Okay, so the panic is over.
Well, the intense outflows calmed down, settling into what the sources describe as only a minor net outflow.
So the emotional, the mass sell-off is over, which tells us that the initial fearful group is probably exhausted. But that doesn't mean the good times are back, right?
Exactly. The panic is gone, but the uncertainty is now the baseline reality. And this stabilization is reflected directly in Bitcoin's price. It has entered what analysts are calling a bottoming phase.
That bottoming phase.
It's trading very narrowly around the $105,000 mark. This is after it briefly dipped below that, that big psychological $100,000 threshold during the peak of October's panic.
So for our listeners who might be newer to some of this financial jargon, what does bottoming out truly imply for an asset like Bitcoin?
It's a powerful but actually a really simple concept. When an asset is bottoming out, it just means the price has found a temporary floor.
Okay.
It's essentially trading in a very narrow, confined range.
Yeah.
We often visualize this as the asset just bouncing sideways inside a box.
So it's not going up, but it's not really crashing down either.
That's it. The selling pressure has, for now, been absorbed by opportunistic buyers. So we shouldn't see more sharp declines immediately. However, it also means the asset has lost the energy or the external stimulus it needs for a major upward breakout.
So it's just stuck.
It's paused, it's waiting, consolidating its losses, and critically, it is waiting for the next major piece of macroeconomic news, which will almost certainly come from the Fed, to give it some kind of direction.
And the reason for this pause, this sideways box, is directly tied to the death of what our sources are calling AI-fueled liquidity. This idea is fascinating to me. How exactly was the AI rally pouring money into the crypto world? And more importantly, why has that mechanism stopped?
This is maybe the single most important structural finding in the research we looked at. For the last, 18 months, we had this positive feedback loop.
Okay.
The massive, accelerating investment and excitement pouring into the AI sector to go the huge funding rounds, the skyrocketing stock valuations of chip makers, it created massive fresh wealth.
Right. VCs, early employees.
Exactly. VCs cashing out smaller stakes, early employees exercising their stock options, tech funds realizing these spectacular returns.
So a lot of new money was created.
A lot of new money. And that generated liquidity, which by its very nature is risk-seeking. When people feel rich, they take bigger risks. So a portion of this freshly printed AI wealth naturally flowed into the highest risk assets that were adjacent to tech.
And crypto is number one on that list.
Crypto, particularly Bitcoin, was a primary beneficiary. It was just coasting on the coattails of the AI capital infusion.
So if I'm understanding this right, if I'm an AI startup founder and my company just hit some massive valuation, I suddenly have cash. And I might put a small fraction of that cash into something high risk, high reward, like crypto. Is that the mechanism?
That is precisely the mechanism. It's the wealth effect translated directly into speculative investment. But now, with the intense debate over the AI sector being in a bubble, a debate we will definitely get into later with CoreWeave, that cycle is broken down. Late-stage funding rounds are stalling, valuations are being scrutinized, and just the velocity of new wealth creation has slowed way down.
The taps have been turned off.
The taps for easy money have been turned off. The sources we looked at explicitly state that crypto must now rely solely on its own internal momentum and fundamental adoption. It's lost its biggest external funding source.
So the entire crypto asset class is now truly on its own.
It's on trial.
Wow. Okay. This shift in how crypto is funded leads us perfectly to the second major finding, a complete reevaluation of Bitcoin's identity. For years, the narrative has been digital gold, an independent asset for, portfolio defense. The data we have fundamentally rejects that idea.
And we have to confront this narrative directly with the evidence. If Bitcoin were truly digital gold, it should exhibit countercyclical behavior, right? It should shine brightest during periods of geopolitical crisis or market panic or extreme inflation.
That should be the safe place to go.
It should be the safe haven. So we look at its performance compared to physical gold, the actual safe haven, during recent bouts of instability.
And the performance profile, it tells the whole story, doesn't it?
It really does. During recent geopolitical flare-ups and periods of high market instability, physical gold did exactly what you'd expect. It maintained its value, sometimes it appreciated, and it fulfilled its traditional role as an uncorrelated portfolio defense mechanism. It was resilient.
As advertised.
As advertised for centuries. Bitcoin, however, did the opposite. It displayed an extreme correlation with the highest risk tech indices, like the NASDAQ. When those indices fell,
Bitcoin fell harder.
It fell faster and deeper. It acted as an amplifier of market fear, not as a refuge from it.
So this means if a listener had allocated, say, 5% of their portfolio to Bitcoin specifically to hedge against a crisis, they would have been doubly exposed.
Not just exposed, but severely disappointed. The data confirms a fundamental takeaway for you, the learner. Bitcoin is not a stability asset. It is not an insurance policy against the traditional financial system.
Not right now, anyway.
Not at all. It behaves exactly, and I mean exactly, like a high-risk technology growth stock. It's an asset you buy strictly to chase exponential returns, accepting massive volatility along the way. It is not an asset for portfolio defense.
So until its correlation with the NASDAQ and other high-risk assets truly breaks, we can't call it digital gold.
We can't. It is a growth instrument, and it's tethered to the global supply of risk capital, period.
Okay. This high-risk context sets the stage perfectly for the most, I would say, bizarre market distortion we've analyzed, the situation with MicroStrategy, ticker MSTR.
This one is fascinating.
MSTR has basically become a de facto Bitcoin ETF, right? It holds enormous amounts of the cryptocurrency. Traditionally, it's stock traded at a premium because investors were willing to pay a little extra for the liquidity of buying Bitcoin through a publicly traded company.
It was convenient.
Very convenient. Now, that relationship has utterly flipped, resulting in what's being called the MSTR discount.
And we are seeing an explicit signal here of extreme market pessimism. The MSTR discount means that MicroStrategy's market capitalization, so the total value of all its outstanding shares, is now lower than the real-time market value of the gross Bitcoin it holds on its balance sheet.
I found this completely counterintuitive when I first read it. How can the market justify valuing the entire company for less than its easiest to value, most liquid asset? It feels like the ultimate vote of no confidence.
It absolutely is.
Yeah.
Let's go back to that storage unit analogy we were talking about, but let's sharpen it a bit to illustrate the consequence of this discount.
Yeah.
Imagine you can buy a public storage unit company for $95, but you know for a fact that the contents, pure, simple Bitcoin, are worth exactly $100.
Okay, so I'm getting a $5 discount.
Right, but that $5 difference represents the market assigning a cost or a risk penalty to the physical act of owning that company to get to the Bitcoin.
A hassle fee.
A hassle fee or a danger fee. And that penalty exists for a few clear reasons, which we have to incorporate into our analysis before we jump to the extreme bear case.
Right, it's not totally irrational.
It's not totally irrational. The discount, even in a neutral market, should reflect at least three things. First, MSTR's operational debt and its liabilities. Second, the high overhead and cost of running its legacy software business.
Which people forget it even has.
They do. And third, the potential tax liability MSTR would face if it ever had to sell that Bitcoin. So these structural costs, they justify some discount.
But the current discount is way beyond what those overheads should account for. So what are the two extreme interpretations that our sources are offering?
Okay, interpretation one, the extreme bear case. Since the discount is far wider than what's justified by debt and operational costs alone, the market is essentially assigning a value of 0 or even a negative value to MSTR's core non-Bitcoin software business.
Wow.
Investors are basically saying, we only value the Bitcoin and we are penalizing you just for having a management team and a server farm.
So the business itself is a liability in their eyes.
Yes. And here is the darker component of that theory. Investors are actively betting that the price of Bitcoin will drop significantly further. So the current discount is just a reflection of what they believe the Bitcoin will be worth in the near future.
So they're front-running a future price drop.
Exactly. The market is demanding a penalty just to take possession of the goods. It's as if the $100 worth of Bitcoin is secretly leaking some kind of toxic risk, and they're demanding compensation just for holding it. This is a profound sign of deep, persistent market mistrust and extreme bearish sentiment.
That level of fear, the belief that MSTR's entire non-Bitcoin business is completely worthless, that sounds like a peak pessimism indicator to me. Which brings us to interpretation 2, the contrarian opportunity.
And for long-term, high-conviction Bitcoin believers, this distortion is a massive flashing opportunity sign. They look at the MSTR discount as a clear signal that market fear has totally overwhelmed fundamental analysis.
Fear over logic.
Right. And this suggests that pessimism has peaked, and any positive news could rapidly close this discount.
So they see it as a kind of arbitrage.
It's viewed as a unique arbitrage opportunity. Instead of buying Bitcoin directly at the market rate, they can effectively buy Bitcoin on sale via MSTR stock, a highly liquid, publicly traded way to do it.
So if Bitcoin just stays flat and the discount closes, they make money.
They make money. And if Bitcoin stabilizes and the discount closes, these investors win on both fronts. The value of the underlying asset could rise, and the stock price corrects to meet that asset value.
But this is not a free lunch. We have to emphasize the risk that's inherent in trying to capture this discount.
Absolutely not. This is an extremely high-risk strategy. That discount exists for reasons that could get worse, Bitcoin could drop further, or MSTR's operational issues could deepen.
The discount could get even wider.
It could get much wider before it ever closes, meaning your capital could be tied up in a negative position for a very long time. The sources suggest the closing of this discount is almost entirely dependent on one single external factor.
The Fed.
The Federal Reserve.
Okay, so connect the dots for us. How does the MSTR discount tie back directly to the Fed's actions?
Well, the crypto market, as we establish, depends entirely on risk capital and liquidity. The moment the Fed pivots from its tightening policy to a clear policy of interest rate cuts, that new liquidity, that spring, will be injected back into the financial system.
And it flows to the riskiest assets first.
Always. It flows first into high-risk assets. That influx of cash would validate the long-term Bitcoin holders, it would ease the market's fear, and it would likely lead to a rapid closure of the MSTR discount as demand for Bitcoin proxies surges.
But until then?
Until then, the discount remains the market's way of signaling fear and demanding compensation for holding illiquid, risky assets in a tightening environment.
That is a brilliant synthesis. The crypto market is truly the litmus test for global risk appetite. Okay, let's transition now from the macro risk of liquidity to the specific immediate credit risk brewing inside the booming AI infrastructure sector. We are moving from the thermometer of the market to the red flashing light on the AI dashboard. This is section 2. CoreWeave and the AI profitability dilemma. So we examined data on CoreWeave, which is a prime example of this AI infrastructure boom. They are a company specializing in buying expensive GPUs and renting them out to AI developers.
A pick and shovel play, in theory.
Exactly, they should be thriving. Yet the credit markets, the highly cynical world of debt insurers, are screaming red flags. So let's look at the financial engineering here. What is a credit default swap premium, and why does CoreWeave's 600 basis point premium signal such acute danger?
Okay, let's simplify the CDS for the learner. A credit default swap, or CDS, is essentially an insurance policy. It's taken out by lenders against a company defaulting on its debt.
So if I lend CoreWeave money,
Right. If CoreWeave takes out a loan and you're the lender, you pay a premium, that's the CDS rate, to an insurer. And they agree to cover your loss if CoreWeave goes bankrupt.
it's simple enough.
So the higher the premium, the higher the cost of that insurance, and critically, the higher the market's collective institutional perception of default risk. We measure this in basis points, or BP, where 100 basis points equals 1%.
Okay, so 600 basis points. That means the annual cost to insure $100 of CoreWeave's debt is $6. That sounds astronomical.
It is. CoreWeave's 5-year CDS premium holding steady at 600 BP translates, based on standard market models, to an implied perceived 40% probability that CoreWeave will default on its debt within the next 5 years.
40%.
40%, a 4 in 10 chance of failure.
Let's just pause on that 40% default risk for a second. That level of risk isn't just caution, that's genuine, deep-seated institutional alarm. How does that compare to a major established tech player?
It's night and day. Consider a major established player in the data center space, like Oracle. Their CDS premium is typically around 100 basis points.
So a 1% insurance cost.
Exactly, which signals an implied default risk of roughly 8% over 5 years. CoreWeave's premium is 6 times higher. The sources we looked at show this mistrust is not a temporary blip. The 600 BP premium has remained persistent. That means the smart money, the debt insurers, are deeply, deeply worried about CoreWeave's fundamental structure.
And this trouble, you're saying, is directly tied to some recent seismic activity in the opaque private credit market, which is where companies like CoreWeave get a lot of their financing.
A huge amount of it.
Okay, so this isn't just about CoreWeave's balance sheet, it's about the lenders. We need to understand the ecosystem that funded this AI boom. What exactly is private credit, and what role did the First Brand's bankruptcy play in raising this CoreWeave red flag?
So private credit is simply debt that is issued by specialized funds, not by traditional large regulated banks. These funds often specialize in high-yield or leveraged loans.
So they take on more risk for more reward.
Exactly. And AI infrastructure growth, the building of these capital-intensive GPU data centers, has been heavily funded by this opaque private credit world because they're willing to take risks that big banks just won't touch.
So the risk is all concentrated outside the well-regulated banking system.
Precisely. Now enter First Brands. Last October, the bankruptcy of this company, First Brands, served as a massive, brutal wake-up call for these private credit funds.
Why them specifically?
First Brands was a major borrower that these funds had heavily supported, and its collapse revealed that the due diligence, the fundamental homework, had been dangerously sloppy. Assets were overvalued, the lenders didn't adequately secure their positions. It was a mess.
That sounds like a textbook moment where caution just snaps back into place, a butterfly effect of financial discipline.
That's the perfect description for it. The sources indicate that CoreWeave is now struggling immensely to raise an additional $1.5 billion.
Because of First Brands.
Yes, because investors, post-First Brands, have tightened lending standards dramatically. Lenders are no longer accepting these easy projections about future AI revenue. They are scrutinizing hard assets. They're demanding more protective covenants. Just rules that trigger a default if the company's financial health starts to slip.
So the party's over for easy money.
It is. And this tightening highlights the systemic risk. AI infrastructure growth was built on a foundation of easy, opaque private credit. If one key player like CoreWeave defaults, it doesn't just hurt that one company. It validates the fear that's embedded in that 600 BP CDS, and it could cause the entire private credit sector to just seize up.
Which would suddenly raise borrowing costs for all AI infrastructure startups.
All of them. Instantly.
Okay, so we have to move beyond just the credit risk and look at the actual business model here. Why is it so incredibly hard for companies like CoreWeave to make money, even when demand for AI services is, through the roof? We're calling this the AI profitability dilemma.
It comes down to a fundamental misalignment in the value chain. You have to differentiate between the shovel seller and the middleman.
Okay.
The shovel seller is NVIDIA. This is the clear winner. They monopolize the profits because they sell the expensive essential component, the GPU, at very high margins. They have all the pricing power, and critically, they don't bear the risk of asset depreciation once that chip is sold. They get their cash immediately.
They sell the shovel and walk away, and CoreWeave is the middleman trying to rent those shovels out.
Exactly. The middleman is CoreWeave. They buy these astronomically expensive GPUs, that's their core asset, and then they rent them out. The third quarter earnings season confirmed what a lot of analysts had suspected all along.
Which was?
AI cloud service margins are razor thin. They're just crushed by the cost of the chips and the intense competition to rent time on those chips. The rental income is simply not generating enough margin to cover that massive initial capital expenditure fast enough.
And this leads us to Michael Burry's crucial point, which you call the time bomb of technological depreciation.
Yes. Unlike a traditional factory where machinery might last 10 or even 20 years, GPUs depreciate rapidly. New models with exponentially better performance are released every 18 to 24 months.
So as soon as the new generation hits the market,
The vast, expensive inventory CoreWeave just bought loses a significant amount of its commercial value, becomes less competitive almost overnight.
so CoreWeave is in a desperate race against a ticking clock.
A frantic race. They have to generate immense amounts of cash flow in a very short window, we're talking less than 2 years, to recoup their initial investment before their main assets become technologically obsolete.
And if a new, faster chip generation arrives.
The debt they used to finance the older chips suddenly becomes much harder to service because the asset that's backing that debt is now worth far less.
This is a critical insight for the learner. We need to look beyond just the exciting growth headlines.
Absolutely. When you're analyzing any AI infrastructure company, you must look at two things besides revenue growth: the speed of asset depreciation and the cash burn rate. If their cash flow isn't quickly outpacing that technological obsolescence, the business model is inherently unstable.
So CoreWeave's 600 BP CDS is basically the credit market's way of saying,
We don't believe they are winning that race against time.
okay, so if the credit market's fears are realized and CoreWeave defaults, what is the realistic worst-case scenario? Could this really destabilize the broader AI boom?
The term AI Lehman moment might sound a little hyperbolic,
A little.
but the underlying mechanics are very similar to past credit crises. That 600 BP CDS is the strongest signal we have that the hype-driven AI boom has hit the structural wall of profitability and sustainability.
So what happens if it fails?
If CoreWeave defaults, the impact will reverberate through the entire interconnected private credit system. Lenders who suffer losses will immediately become ultra-conservative. They'll panic, and they'll pull back funding across the entire sector. A default could trigger a devastating chain reaction of credit crunch.
That would mean much higher interest rates or even an outright refusal to lend for every other AI startup that relies on this kind of financing.
Precisely. It would validate the extreme bearish view that the sector was over-leveraged and built on credit that was just too easy and risk that was mispriced. This capital freeze would halt expansion projects, stop new GPU purchases, and it would slow the entire pace of AI innovation that depends on this external infrastructure.
So CoreWeave's survival it's a barometer.
It is a crucial barometer for the entire AI ecosystem. If it fails, it confirms that the party was fundamentally built on financial fragility, just transferring high-risk investments into these opaque private credit funds. The entire market needs to treat this 600 BP CDS as the financial system's loud, unmistakable warning that the AI bubble is dangerously brittle.
From the brittle nature of high-risk AI growth, let's now pivot entirely. We're moving to the quiet, highly calculated, multi-billion-dollar move made by the ultimate long-term investor, suggesting where true, enduring value lies in the modern digital economy. For the last year, Berkshire Hathaway, under the direction of Warren Buffett, has been sitting on a colossal pile of cash. I mean, a staggering $200 billion.
So much dry powder.
So much. The market has just been waiting, watching where the Oracle of Omaha and his team would deploy this war chest. It represented massive buying power, patience personified.
And we finally got a clear answer on November 14th via the required 13F filing. The confirmation of a new, substantial $4.3 billion stake in Alphabet, Google's parent company.
And this was far more than just a typical trade, right? This was a strategic declaration.
It really was.
And the timing of this investment, it feels absolutely critical. This news landed shortly after some high-profile criticism, specifically from Wall Street analysts, suggesting Berkshire was becoming, well, obsolete.
Right, the old argument.
The old argument that the conglomerate would inevitably underperform because it was AI exempt and had been left behind by the technological revolution.
And this investment is the most direct, clearest possible rebuttal to those critics. Berkshire essentially responded by saying, we are not avoiding the AI revolution, we are simply engaging with it on our own terms.
I love that. On our own terms.
They did not chase the speculative AI startups. They bought a foundational, profitable digital giant at a time when others were questioning its future. The sheer volume of that $200 billion cash pile meant that every deployment was a signal.
Every move is watched.
And by choosing Alphabet as the first major disclosed destination, they underscored their commitment to what they deem high-quality tech assets companies that have already proven their dominance and profitability, not just their potential.
It's a classic Buffett move, but it's perfectly adapted to the modern economy. It's an acknowledgement that while the world has changed, the fundamental rules of value investing, patience, and quality have not.
They absolutely have not.
So, Buffett famously regretted not buying Google earlier in its history. He called it a mistake. Is this investment simply the oracle correcting an old error? Or are we seeing the deeper, evolving influence of his successors?
I think the size and the nature of the investment strongly suggest this is the work of the post-Buffett team.
Ted and Todd.
Investment managers like Ted Weschler and Todd Combs, or even strategic influence from the heir apparent Greg Abel. While Buffett likely approved the thesis, the day-to-day sourcing of these value-oriented technology plays often falls to his deputies.
So it's an evolution.
It represents a gradual, but I think undeniable evolution of Berkshire's investment philosophy. They are not discarding the old playbook. They are adapting it to what we are now calling valuable technology, or value tech.
I like that term, value tech.
They seek the characteristics of a traditional value, stock durability, consistency, pricing power, but they're finding it within the tech sector.
So why Alphabet specifically? I mean, when Microsoft and NVIDIA were capturing all the AI headlines and seeing spectacular stock growth, why choose the perceived laggard?
It comes down to a laser focus on two core value investing concepts: the moat and relative undervaluation.
The classic.
The classics. The moat, the enduring monopoly. Berkshire's primary concern is always the economic moat, that fortress that protects a company's profits. They already executed this shift with Apple, remember?
Right. They saw it as a consumer staple, not a tech stock.
Exactly.
Yeah.
They recognized it had matured from a cyclical hardware company into a dominant consumer staple. And they now view Google similarly. It is a must-have infrastructure for the digital age.
Okay, break down that moat for us.
You can break it into three components. First, search dominance. I mean, Google maintains a global, overwhelming monopoly in search. Even with AI challenges, this is a highly defensible, high-margin asset.
It's the default.
It's the default. Second, YouTube. The sources view YouTube not just as entertainment, but as an irreplaceable global advertising platform with immense pricing power and stability. And third, cloud. While cloud profitability lagged a little bit, Berkshire likely views it as a solvable temporary issue, betting on the long-term growth of that necessary infrastructure.
And the relative undervaluation piece, that's where the patience paid off, correct?
Precisely. While competitors like NVIDIA soared on pure AI excitement and forward-looking projections, Alphabet lagged its peers. Its stock experienced a period of relative poor performance.
Why was that?
It was largely due to two short-term fears: intense market worry that new AI competitors like OpenAI and Microsoft would instantly destroy its search dominance, and temporary slowdowns in its cloud segment.
So the market was panicking.
The market was panicking, and to a value investor, this was the perfect storm for buying. You have a company with overwhelming dominance and multiple defensible monopolies currently trading cheaply because the market is freaking out over temporary or cyberable issues.
So they were betting that the market was just wrong.
They were betting that the market was drastically mispricing the long-term, entrenched nature of Google's fundamental business structure.
This $4.3 billion stake isn't just about Berkshire's portfolio, is it? It's a masterclass in patient, disciplined investing for everyone watching the markets. What are the practical lessons we can extract from the Oracle's decision and apply to our own allocation strategies?
I think we can synthesize 4 powerful, actionable insights based on this analysis.
Okay, let's hear them.
First, value investing is evolving, not dying. The core principle is not attachment to specific sectors like smokestacks or railroads. The core principle is finding a company with an overwhelming economic moat and buying it at a reasonable price.
And the moat just looks different now.
The moat in the 21st century looks like Google's global search and video dominance, not just a physical railroad track. This investment proves that deep, durable value can be found in the technology sector if you are patient enough to wait until the hype-driven premium fades.
So the asset class changed, but the underlying methodology remained ironclad.
Exactly. Second, this acts as a strong confidence guarantee for Alphabet. By deploying billions, Berkshire is signaling that they believe the short-term worries, the AI competition fears, the cloud struggles, are fundamentally overblown.
It's a stamp of approval.
It's an institutional stamp of approval that strongly suggests the underlying value in search and YouTube is durable, and that the stock was indeed relatively undervalued. They are confident the moat will hold.
Okay, what's number 3?
Third, this weakens the argument that Berkshire itself is a relic. This investment confirms that Berkshire is a developing giant value stock, capable of adapting its philosophy and utilizing its financial might to enter new dominant sectors. The argument that the company will be left behind by the digital age now looks much, much weaker.
And the fourth and final lesson.
And finally, the most classic lesson for everyone managing their money. Cash is the ultimate weapon. Berkshire's $200 billion war chest wasn't a liability. It was their greatest strategic asset. They resisted the euphoria and the frenzy of the AI boom. They saved their cash while others were desperately bidding up prices. They waited until the market sold off a quality asset, Alphabet's relative poor performance. And then they seized the deep value opportunity.
That patience is just invaluable. They weren't forced to join the party when the music was loud and prices were high. They waited until a dominant company became available at a discount.
And it's a powerful demonstration for everyone that resisting market frenzy and saving your cash is crucial for seizing these genuine generational opportunities.
It really confirms that your primary task as a disciplined investor is often just to avoid being swept up by euphoria, maintaining liquidity, and waiting for the market to inevitably hand you a high-quality asset on sale due to temporary fear.
That's the whole game right there. #Actro.
Okay, let's synthesize the 3 core insights we covered in this extensive deep dive.
Let's do it. In the crypto world, the core lesson is one of risk reality and liquidity dependency. The massive $800 million outflows, the persistent MSTR discount. It all confirms that Bitcoin is acting like a high-risk growth stock, not digital gold.
And it needs that fuel.
It needs fresh, new liquidity, which really means a Federal Reserve policy reversal, to achieve any significant momentum. That demands extreme caution from you until that signal arrives.
And in the AI sector, the key insight is credit fragility and structural risk. CoreWeave's sustained 600 basis point CDS premium is a powerful warning that the AI infrastructure boom has hit the concrete wall of profitability.
So you, the investor, you have to look beyond the spectacular revenue growth. You have to deeply scrutinize the destructive speed of technological depreciation and the high cash burn rates, especially given how much risk is centralized within those opaque private credit funds.
And finally, the enduring lesson from Berkshire Hathaway's $4.3 billion Alphabet move is the necessary evolution of value investing.
It proves that the core tenets, finding an overwhelming economic moat and buying at a reasonable price, applied perfectly to the digital giants. It's a highly visible vote of confidence in Alphabet's long-term dominance as a foundational digital asset.
So what is the ultimate takeaway for you, the learner, after all this? The market is currently rewarding hype in early-stage AI while simultaneously punishing perceived weakness, as we saw so explicitly with the MSTR discount.
Your job is to exercise discipline, to clearly distinguish between a truly valuable asset with a strong, durable moat like the dominant positions held by Alphabet, and the high-risk speculative bets that are dependent entirely on continuous, easy liquidity, like the more fragile AI intermediaries we discussed.
Patience is your fortress.
It is. And here is a final provocative thought for you to consider as you wrap up this deep dive.
Okay.
The market's extreme, almost irrational pessimism regarding MSTR, the fact that the company is valued at less than its cash, suggests one of two things. Either a fundamental failure in Bitcoin's utility narrative, or that market fear has reached its absolute peak.
So what's the question?
The question is this. What fundamental shift, perhaps a commitment by the Federal Reserve to cut rates by 100 basis points, or a new piece of financial regulation, what would be required to fully close that MSTR discount? Pondering the specific external stimulus required to resolve that distortion will illuminate the path out of this current investment uncertainty.
That's a fantastic note to end on. Don't forget to subscribe and hit that like button.